Well, welcome to Quiver Financial's weekly financial market update for February 7th, 2025. And it is bright and early on February 8th, Saturday morning. You may have some background noise because I got family visiting, but let's dive into this because this week was an amazing week for all of us Quiver Financial people. Next week could be even more important because of what is going on in the Trump administration. So let's dig into it real quick so that way you can get on with the rest of your weekend just like I need to. So what we're going to talk about is gold. Gold's a big topic on CNBC this week. So I'm going to talk, is it time to sell or is it buy, baby? Because I'm going to show you some charts that are going to give you an idea of where this rally may end and whether you should be a buyer or seller at this time. We're going to talk about oil and energy because it held support exactly the way we needed to. However, I'm really anxious about this week because, is oil determined to make Trump angry, or is Trump and Bissett actually going to be able to push energy prices lower with some of their policies? Next week is going to be a big tell because the technicals on the charts are saying a lot of different things than what the administration is. So see what we're seeing. And we're going to talk about how we're playing it. Stocks, the stock market, it continued to go nowhere this week after more big tech earnings. There's been a trend the last 3 weeks, really since the start of the year, where we drop on Monday and rally back the rest of the week. And then in earnings season, whether it's been Microsoft, Amazon, Google, they report earnings. Earnings are pretty good, but their forecasts, their forward projections are a little soft. And so we're getting very muted or negative responses to earnings. At this point, over half the market has reported earnings. So I don't think for the rest of the month, we can expect much oomph in stocks from the earnings season or earnings that are less. So we're going to dig into that. I'm also going to show you something about a company that says, something doesn't smell right in Denmark. Things that make you go, because if the chip sector is as strong as everybody says it is, if all these companies are reporting all this CapEx, then there's one stock that just really puzzles me. And I'm going to show you that because it really makes me go, is all this rhetoric true or not? And then rates. This is the most important story for every investor this year is what's going on in the 10-year Treasury yield. Is it going to stay below 5%? Will Goldilocks stay in the house? Is she getting anxious? I'm going to show you some charts this week of how the 10-year Treasury did exactly what we needed to if we want to hold interest rate sensitive investments. However, next week could totally change that. So it's going to be a huge week next week. So stay tuned. Let's dig into what we're watching and what we're doing. So let's start off with our big themes for this year. To recap for anybody that's new, is our themes this year is that we'd like to see interest rates stay between 4 and 5%. We call it the Goldilocks theme. I'll show you why, and I'll show you the charts. I'll show you a couple REITs, traded REITs, and how they're performing. They're great for people who are looking for income if they can manage the risk. Little disclosure, none of this is investment advice, folks. Never take investment advice from some schmuck on YouTube or anybody else. Now, if you want to take advice from somebody who knows you and realize these videos are really targeted for our Quiver Financial clients. And our clients, we know everything about them. In some cases, we know more about them than their families do. So if you have a relationship like that, then fine, take advice from somebody in that kind of relationship. But do not take and act on any financial advice from a video online because guess what? Just because it's online doesn't mean it's true. So let's get back into the real information here. So stock markets, our theory this year is the stock market, the bull is tired. So investors, if you're going to be in the market, look for value. What we've been doing is we've been hedging our bets in tech. And we've been adding higher value sectors like utilities and energy for the clients that can withstand the risk. So see what we're watching in the charts and what we anticipate doing over the next few weeks. Metals, boy. Gold is just the shiny thing that everybody's watching. CNBC was talking all about it this week. They're in rally mode. So now, are we going to continue to grind higher, or are we getting ready to go into one of these parabolic moves where it just blows off the top? Let's talk about that. I'm going to show you what we're doing. I'm going to tell you what we're going to be doing since we've been owners of gold and silver for quite a while. And then lastly, oil. It's a big story. What's going to happen next week? Because, Trump is drill, baby, drill. They want to push prices down. However, when you look at the charts and you look at the patterns, oil's broken out of a long sideways pattern that normally indicates higher. So we're going to talk about, will oil be the Trump administration's kryptonite? And I'm going to tell you, I'm going to show you the tell that I'm watching for to help determine whether you should be in the energy sector or not. All right, so let's start off with interest rates, because that is really the most important factor of this year. We really have been talking about the world of interest rates and the fact that we would like to see the 10-year Treasury stay in this Goldilocks range of 3.5 to 4.5. We've revised that to really be hey, if we can say between 3.5 and 5%, and a lot of good news can happen between 3.5 and 5%. When people are worried about the economy slowing down or recession, we probably go towards 3.5. When people think the economy is heating up, we go back towards 5. What we don't want to see, anybody, is we really don't want to see rates get above 5% on the 10-year. If you watch mortgage rates, that means about 7%. They can spike above, but we don't want them to sustain trading above that level, because if it does, everybody on Wall Street has to go back and sharpen their pencils and redesign their models. This is what we've been watching. A few weeks ago, what was the date on this? Let me move my little picture. So at the end of January, we noted that the 10-year Treasury pivoted exactly where we needed to, right around 4.76%. What we've been watching is our confidence level would increase significantly if we can get below 4.5%. And this week, we started to get there. We're almost there, So here's this week now. Let me move my little picture out of the way. This week, we got just below 4.5%, and we closed right there. Talk about anxiousness, because I've seen this pattern before where you can undercut a level of support and then all of a sudden go off to the races. So this coming week, what we really want to see is we'd love to see the 10-year continue to back down and go towards 4.25. If that's the case, then if you own interest rate sensitive investments like treasury bonds, traded REITs, or even utility stocks, if you get a trend lower in rates, those types of holdings tend to get a tailwind and could move higher. They pay great income. I'm going to show you a couple of charts of those in a second. It's okay if next week we start off a little bit above 4.5 and we rally up a little and then reverse, but what we're really, really looking for, if you want to really back up the truck on interest rate sensitive, high yielding investments, is we really want to see this 10-year get down into that 4.25 range. It does look like that's happening, but we need another week. So stay tuned and pay extra close attention next week, because I'm going to update you then. Here's some of the charts on the real estate trust we were talking about. We've been highlighting EPR properties. I didn't update the chart this week because not much happened. It's bounced down to 46, back up to 48 this week. I think it ended the week right around 47. Point being is that EPR has held. They've held their support levels. Things are pivoting, and the big thing is, folks, is that if Wall Street money managers were really convinced that the 10-year Treasury was going to get well above 5% and stay there in the near time frame, I don't think they'd be coming in and buying a holding like this. They'd normally be selling it. So this is one of those tells I'm watching on interest rates, because investors tend to move with their money before the rate market does. So this is a little speculative watching. So keep it on your radar. I'm not telling you to go out and buy this, because you got to make sure you have the right kind of risk profile, but definitely keep it on your radar as we go through the next few weeks, and I'll keep updating you. Another one's Annaly Mortgage. It's a mortgage REIT, very interest rate sensitive. We pointed it out at the beginning of January when it was down here at $18. We said if rates can get down towards 4.5, it'll probably rally up to 20, which is exactly what it did. Little did I know it happened in a couple days or a couple weeks. But here again, here's something that pays a monthly dividend. And if rates stay within that Goldilocks range, could be accretive to a portfolio. So we'll keep that on the radar. I'm going to move into metals and energy because gold is the big talk of the town. You can see here that actually I'm going to start with oil. Sorry, apologies. Oil, we've been highlighting, has been in this long-term consolidating pattern. You can see in this chart from 2021 as we came out of the pandemic, oil prices rose from basically $15 a barrel all the way up to 80 in 2022. And then from there, all of 2020, the rest of 22, all of 23, and all of 2024, oil prices just basically bounce between 60 and 80, which means all the analysts that cover Exxon, Chevron, those companies, they've built all their models on earnings based on oil being in this range. And what we've been talking about is we've seen these patterns over the years that when they consolidate like this for many, 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 many years or months, that when you break out of this pattern, most likely the direction of that breakout is the new trendy move, like the next move for the next year and a half, 2, 3 years. So I find it very interesting that as Trump gets inaugurated and as we get into this administration, that's drill, baby, drill, we're going to push prices lower, that you have a situation that oil prices then rebound, or actually not, they don't even rebound, they just spring boom, right out of this pattern higher. Very bullish breakout. And normally, because this is probably a short squeeze, you're going to correct it down. So we were watching, would we get a narrow, like a shallow correction and then go off to the races? Because that'd be incredibly bullish. Not great for your pocketbook and inflation, but it'd be bullish for energy investors. Or would we get a bigger correction back down to support? And that's exactly what happened. It was probably more appropriate. So now we've come down to this level of $76 a barrel, which you can see here. This is a little gap. This is a little gap. Markets are all about price discovery, so they love to fill these gaps. So now that these gaps are filled, we still have one up here that needs to be filled. So my thought process is if this coming week, the oil markets can stay above this 76 line, in the midst of all this rhetoric about Trump's going to bring prices down. We'll see if he can, because the market is the market. If that's happening and this thing reverses and gets back up to 80, then participants in the market are going to start to look at this differently. And if you're in the energy sector, if you're an analyst, like I said earlier, and you made all your earnings projections based on oil sticking around $70, or worse, a lot of them were thinking it'd get down to 50 in the Trump administration because of drill, baby, drill. So if you're anticipating those things and now oil stays between, let's say, 75 and 85, well, those analysts need to go back and redo all their analysis and give a little multiple expansion to the energy sector. So that could be very good for people that are invested in the energy sector if it happens. So we're watching that on the XLE because this week it did come down. It ended this week right on this level of support. Next week, if that holds and moves higher, we could see some pretty violent moves within the energy sector that would be positive for investors, but not necessarily so great for the inflation front. So keep this on your radar, folks, because next week or the next 2 weeks are going to be really, really important. So I encourage you to stay in touch here. Gold. Now let's move on to gold. Gold is just keep moving. Everybody's talking about Bitcoin. Everybody's talking about NVIDIA. Everybody's talking about all these things. But you know what? Grandpa's old gold is doing just fine. So let's look at this. We broke out above resistance without any hesitation, folks. I mean, we broke above it. We retested it for a couple 2 days and then went off to the races. there's probably two patterns here. It's either straight up from here, or we get a corrective phase that brings us back down to support. We got, back to what used to be resistance, and we test that level of support around 2,500 an ounce, and then go higher from there. What I'd be looking for, as if that did not happen, is this trend line. Okay, so this green trend line, if you break below that green trend line, then this bullish phase could be over. So, there's two sides to every coin I like to look at. I believe gold is going higher, in my opinion. Do not run out and chase this at this moment, because realize us as Quiver, our clients, we've been owning gold and silver for over a year and a half. So as this rallies higher, we're probably going to be sellers. So just realize that I'm talking about it because it's our book. We're already in it, and we're looking for an exit because we've been waiting a year and a half to take some profits here. So this is very exciting, especially for the Quiver clients. I encourage you to keep gold on your radar. Silver, if you are looking to play it, and let's say you feel like you've missed the move in gold and silver, you can look at the miners. You can look at gold miners and silver miners, because they'll play catch up as a stock price. But I'll also forewarn you that the mining business and the stocks of mining, they're just crappy stocks, because the CEOs of those companies, they've had to constantly dilute their stock in order to keep everything operating. So they're just typically not great stocks. You only really want to own mining stocks while there's a gold or silver rally happening like now. So it's something you can look at, but just, I wouldn't talk to them. I wouldn't consider them as long-term investments. They're a trade, folks. All right, so let's get into the last section and wrap it up with equities, because, equities is like the Marsha of the Brady family. Everybody loves equities and wants to talk about it. So I'd love to give people a little warning that, hey, if you look at the market from the perspective of 2008 was our last major reset, and then you take like an Elliott wave pattern and add on to it, you can see that since the 08 demise, since the bottom, we have a pretty defined, clear 5 waves up. And the Elliott wave basically says, as you get into the 5th wave, just like as you're on the freeway, you should be looking for your exit. So we're getting into a point here where markets are, high valuations. What's been leading the market, like the technology sector, since the start of the year, what we would call the generals, look to be very soft and weak after earnings. We always talk about how the market could go through a correction is when the generals get taken out and shot, and that seems to be happening. However, when you look at the market, one other thing that should be also a big factor that everybody talked about this week, it was in Twitter space, is that everybody's in the market. All the small investors have jumped in. There's like almost no cash when they do these surveys out there. So it raises the question that if everybody's in, who's left to buy to push the market higher? And the theory, the long-term statement from Warren Buffett and many others, which is when everybody else is greedy, you should be fearful. And when everybody else is fearful, you should be greedy. So if you're brand new to the stock market investing thing, I just forewarn you that you're getting in when the water's pretty deep. And so you might want to just think about, if you're jumping into tech stocks, if you're jumping into the stock market, how to do that strategically. Call us. We'll help teach you how you can do it in a way to manage your risk, so you don't wake up one morning and realize, oh, shit, 20% of my portfolio is gone. So we can really teach you how to manage risk. I'm going to show you one way to do that right here. Is for us, when we feel like the market's getting a little top heavy and could tip over on us, we start shortening up our grip on the bat, and we start looking at the market on a 10-day, week by week basis. Last week, we said, hey, we're this 60-40 zone, below 60-40, above 59.80. So let's call it right around that 6,000 mark on the S&P 500 is our warning zone. And we're closed this week right on top of it. So what you're seeing here on the chart is last week's chart. We closed right on top of the warning zone. This week, we opened up with a big gap down on Monday, making us feel like it was going to sell off. Same thing that happened the week before. Big sell off on Monday. The rest of the week, the market climbs back. And then you get a couple earnings reports from Amazon and a few others, and they just don't react well. And we closed the week right back. So it was like a whole week of nothingness, just like nothing but noise. So next week, this is the zone to watch, is if we start to get below that 5,900 level, then we might be starting to see a larger correction. And that could create an opportunity for anybody who's got a little bit of cash. So the last thing I'm going to talk about here, folks, is I'm sure you've been watching CNBC or the news, and you hear about the chip sector, microchip sector, things like NVIDIA specifically as being the hot area of the last year and a half, as like everything around artificial intelligence, AI, is centered around these chips. And there's been some rumor out there that companies like NVIDIA may not be what they appear to be, kind of like in the .com era, when you had an Enron blow up or a WorldCom, where all of a sudden you found out that the way they were doing their accounting was a little funky. So there's been some of those rumors around NVIDIA for a while, and nothing's really come of it. But I do pose this. This is a stock we recently added to our portfolio. It's a company called ASML. They're a Dutch company. They make lithographics, which basically you need them to make any kind of microchip. You cannot make any kind of microchip without a product from ASML. They essentially have a monopoly on this. So what I'm showing you here is a chart of ASML over the last year. And I just posed the question that why, if NVIDIA has been clipping off earnings after earnings that are impressive, if Facebook, Google, Microsoft, Amazon, if they're coming out and announcing $80 billion, $100 billion, $60 billion capital expenditures, they're investing into chips, the presumption is that billions of dollars is going to NVIDIA. Well, if it is, why isn't ASML stock, every time they've done their earnings, they've had these breakdowns? So if ASML is if NVIDIA is one of ASML's biggest customers, and NVIDIA is saying they're buying or building all these chips and selling them, don't you think the supplier, ASML, to NVIDIA should be doing better as a stock? So this is just something that I look at as a tell and go, something doesn't smell right here. And I'm not saying that it's going to develop into something bigger. It's just something I point out that in markets, if you get muted responses to earnings like we have, and then you eventually have people digging into the big generals and finding weaknesses, that's when you're kind of poised for some kind of market correction. Great news is, if you look at the rest of the markets that we were looking at, you don't have to be 100% in the stock market. You can have, like our clients, a portion of your money in energy, a portion of your money in utilities, a portion of your money in gold and silver and oil, even palladium or uranium. There are so many ways to diversify a portfolio, and there's always a bull market somewhere. I mean, you've heard that before, but there's always a way to find money in these markets. So I encourage you to stay in touch with us. If you have questions about your own portfolio, there's the bell. The dogs are ringing. It means it's over. All right, folks, we're going to wrap it up this week. Stay tuned for next week, because it's going to be a big week, especially around energy and oil, as well as interest rates. So stay tuned, folks, and take care.